Years ago, I warned that exactly what is happening right now would happen, and for the precise reasons that it's now happening. Now, I don't know anyone else that talked about it, right? So the mainstream media looks at this as like, oh, well, nobody could have predicted this. Yes, people did predict it. I know I was one of them, but it's going to get a lot worse from here. That's what the mainstream still doesn't understand. And so what happened with Silicon Valley Bank is they announced they couldn't find any takers for that stock. I wonder why, right? Nobody wanted to step up and catch that falling knife. So the bank couldn't raise the capital that it needed. And so it's been put into receivership by the FDIC. So the bank is shut. It's probably worth nothing. So you had a bank go from 300 to 0 in basically one trading day. Totally out of left field. In fact, last month, Forbes magazine came out with its best banks in the United States. It made a list of best banks, and Silicon Valley Bank was number one. It topped the list, and in 1 month, it's bankrupt. Now, the bank had something like $175 billion worth of deposits, $150 billion of which are not insured. The FDIC insures 250,000 of deposits. If your account is worth more than that, it's not insured. I mean, you're protected up to the 250, but beyond that, you're on your own. And this is a big deal. So first, let me get into what happened to this bank and why. And this is just one domino. A whole bunch of them are going to fail. The dollar was down today. Investors are anticipating some type of Fed pivot where just a few days ago, they thought, no, that's not going to happen. But the events from Silicon Valley Bank has now got people thinking that the Fed is going to have to do something. And they are going to have to do something, except it ain't going to work. That is the problem. That's what nobody understands. So getting back to what happened with this bank, and this again is something that I was warning about years ago. But one of the downsides of low interest rates, I've been warning about this, and that's why we don't own financials in our brokerage account. I mean, we stayed away from the financials for this reason, because lots of people were saying higher interest rates are going to be good for financials because they can earn more money. I was one of the few people out there that said, no, higher interest rates are going to destroy finance, because most people in the investment banking business don't even understand their own industry. Why do you think so few people knew that the 2008 financial crisis was coming? I understood the weak position that the banks were in during the housing bubble, and I understood how weak their position was now going into this coming financial crisis. Everybody else, the banking system is sound, it's sound. It is completely unsound. Here is the flip side of low interest rates. While interest rates were really low, all of these banks, in order to earn income, had to take their deposits and invest them in low-yielding paper. They bought a lot of government bonds, treasury bonds. That's what they had to have. That was considered excellent collateral, right? Full faith and credit of the U.S. government, except they didn't buy short-term because there was no yield there. The yield was at zero. So what did they do? They bought 10-year treasuries, 30-year treasuries at maybe 1.5%, 2%, not a lot of yield, but better than nothing. So they bought all these bonds. They also loaded up on mortgages, either the ones that they originated or they bought them in the secondary market, mortgage-backed securities. Personally, I've got a mortgage on my Connecticut house. I got a 30-year fixed. Maybe there's 25 years left on it, 26. I'm not sure exactly. But I'm at 3 3/8. The current mortgage rate is 7%. What do you think that mortgage is worth? If Bank of America, which owns my mortgage, if they wanted to sell that, they're not going to get anywhere near what it's worth, anywhere near what they've marked it on their books, because they're not marking that loan to market. No, they're pretending it's still worth what I owe them, but it's not worth that. I mean, yes, it's worth that if they hold that mortgage for the next 26 years, but what if they need to sell it? What are they going to get? What can you get for a mortgage at 3 3/8 when the current market is at 7? That's the position that Silicon Valley Bank was in, because a lot of their depositors wanted their money back. Now, one reason is they bank a lot of tech companies, and these tech companies are in a lot of trouble. They're losing a lot of money, so they're tapping into their bank deposits. Maybe they deposited some of the money that they got from selling stock to a bunch of suckers, but now they need that money to cover their losses. So they go to their bank and they ask for the money. Now, the bank doesn't just sit on the cash. In order to get the money, they got to sell their mortgage-backed securities. They got to sell their U.S. treasuries. Well, what are they worth? A lot less than they have them on their books. That's why they lost a lot of money, and now they need help. But there's also something else that's going on. This is another thing that I predicted. Interest rates are going up, and you can get almost 5% now on a treasury bill. Money market yields have moved up a lot. But if you've noticed, if you have a bank account, your bank is barely paying you any interest. Maybe you're getting 25 basis points, 50 basis points. You're not getting anywhere near what is currently being offered by the U.S. government on treasuries, on bills. Why is that? Because the banks can't pay, because they've already loaned out all the money and they're locked in at these low rates. So they can't pay their depositors enough interest to compete with the U.S. government. So what is that going to do? That's going to create a run on the banks, not just on Silicon Valley Bank, but all these small banks, these regional banks. People are going to start pulling out their money. Now, the small depositors, guys got a couple of grand in a checking account, probably doesn't care about interest. But you've got some of the larger deposits, like this bank. Most of the deposits were big. They weren't covered by FDIC. If you can get 5% or 6% eventually, in a money market somewhere, but your bank is only paying you 50 basis points, just pull the money out, send it someplace else. The problem is the bank don't have it. They got to sell something to get it. But what they're selling isn't worth what they owe you. We have so many U.S. banks that are completely insolvent right now because none of them are marking their loans to market because they have them qualified as hold to maturity. Oh yeah, we don't have to mark this to market. We're just going to hold it to maturity. Well, sure. But what if you can't? What if you face a situation where your depositors want their money? Well, now you've got to sell, and then you don't have their money. See, everybody was talking about how great it was that all these Americans got to refinance all their mortgages at low rates. And I was pointing out for years, it's great for the borrower, but it's a disaster for the lender. I was saying for years, what is going to happen when interest rates eventually rise and all these banks are stuck with this low yielding paper? Sure, when they were able to borrow from the Fed at 0 and then reinvest at 2%, well, they still made money. But when it costs you 5% to borrow from the Fed and all your deposits are yielding 2%, 2, whatever they are, and your customers want a competitive rate of interest, after all, we're living in a high inflationary environment. You got to pay up. You got to pay a higher rate of interest when there's a lot of inflation. The banks can't do it. And so what was good for the borrowers is a disaster for the lenders. The problem is all of these lenders are backed up by the U.S. government. What's going to happen to Silicon Valley Bank? Who knows how much this bank has actually lost? But the insured deposits are protected by the FDIC. Well, where does the FDIC get its money? From the government. Well, the government is broke. The government is already running a massive deficit. So where would the government be looking to get the money to bail out the FDIC? Well, normally from the Federal Reserve. But the Fed's doing quantitative tightening. That means there's no money there. The cupboard is bare. So where is the FDIC going to get this money? It can't get the money. That is the problem. The banks are going to fail, and there's no way for the FDIC to bail them out. Now, of course, they will bail them out because the Fed is going to reverse and supply the money. But you know what? Depositors are screwed either way, because if the Fed decides to keep fighting inflation, which means it can't bail out the FDIC, well, that means there's no money in the FDIC. And if the government is going to bail out the FDIC, it's going to have to sell the bonds into the private sector. And the sale of those bonds will put even more downward pressure on the bond market, which will cause even more banks to go insolvent. And the ones that are insolvent will only be deeper insolvent. So if the government has to sell bonds to bail out all the banks that own bonds and are losing money, it will exacerbate the losses on those bonds, making the problem worse. But if they can't do that,